Hello friends, today we will discuss another important subject in export-import operations. It is duty drawback. Dear friends, duty drawback refers to refund of input duties. Before I go into detail of duty drawback, let me explain what exactly is duty drawback. Duty means taxes. Dear friends, then what is the difference between duty and taxes? Taxes are paid after they accrue, and any tax which is paid before it accrue is called duty. Drawback means withdraw. Withdraw means refund. With anything, we say usually a party has withdrawn, a government has withdrawn, a decision has been withdrawn. If wherever the term withdrawn come, it means that it is giving back or taking back. Dear friends, in export chain, exporter pays several taxes. With the introduction of GST, a lot of taxes has been harmonized into one tax. It has been one of the greatest reform by this government. But still, there are certain taxes which cannot be, harmonized within the GST regimes. I take, for example, there is one tax called import duty, custom duty that we pay. Dear friends, any tax we pay, it is the honored right of every exporter to get that refunded, because in export operations, the goods are exported, taxes are not. Taxes are refunded back. And our government under GST, under section 96 subsection A, has made it very clear, all taxes which are paid must be refunded back. It's a global convention. Every government, every country make it a point that any tax which is being paid by the exporter must be refunded back, because by refund of taxes, the landed cost of the product or the cost of production of the product become less, and exporter will be in a position to effectively engage in international market. Goods become cheaper. As a result, he will be able to sell more. When he sell more, he get more business. When he get more business, more foreign exchange comes to the country. And that's the reason that Government of India announces duty drawback rates for the goods which are manufactured in India and exported out of India. So we will delve in detail the issues which are related to duty drawback in today's session. So dear friends, we were discussing what are duty drawback. Duty drawback refund refers to refund of custom duty which we suffer during the course of import, which is paid at the time of import clearance of goods, which will be used in a exportable product. So let me take an example and take it forward during the course of discussion. There is a manufacturer, automobile manufacturer based in Gurgaon. Hypothetically, let us name it also. For example, there is big players in Gurgaon like Maruti. When they manufacture a car, they have to source several components. For the domestically sourced component, under GST, the regime has been very simplified, has been made very transparent, and it has become very easy to claim the input credit, which we can set off against the domestic sale. When we make our domestic sales, we can set off the input duty claims that we have on the components that we have sourced from the various domestic suppliers. So this has become much easy, but when we import goods, we have to pay two duties, first being custom duty, second being IGST. IGST we claim as an input credit in our books and set it off against our domestic sales. But custom duty is still not the part of the goods and service tax. So we pay that, we suffer that, and that must be refunded. The definition is very clear. Any input duty which you suffer, which otherwise is not neutralized, will be refunded, because exporter is a lovely son and lovely daughter of Government of India. There are certain elements for that refund. Goods must be exported. So when you file shipping bill, when goods move out of India, there are proof. Shipping bill is first proof. Let export order on the shipping bill. Then export general manifest is filed by the shipping company. Third is the bill of lading, which is ultimate proof because the goods had moved out of India. Fourth is the EBRC. These are the proof of export. So good must move to a foreign port, and these can be the proof. We will discuss how to comply them. And once you file shipping bill, there are several type of shipping bill. For example, ATA Carnet shipping bill. Then there is a shipping bill under claim of duty drawback, duty-free shipping bill, dutiable shipping bill, duty-free shipping bill for X bond, and the goods which are exported from EOU, EHTP, BTP, STPI. So in case you have suffered any incidents of duty by importing certain components, certain parts which are used in the product which has to be exported out of India, dear friends, you are eligible to claim refund of that, because Government of India say goods are exported, taxes are not. So under Customs Act, there is a detailed procedure for refund of those taxes. And let me first explain what are the various types. So the sections are Section 74, Section 75, and Section 74 covers two types of drawback. Export goods imported into India as such. I mean, goods imported, goods re-exported. So you import certain cargo. Let us assume there is a gentleman based in Hyderabad. He import the cargo from China. It is a basically electronics cargo. He import it. He clear it at Sanat Nagar in Hyderabad. And then he export it to Dubai. When he import, he pays certain duties. Those are import duties. And when he export it, he is entitled to claim refund of the duties which he has paid. And that is known as what we call as duty drawback. Now assume there is another exporter based in Bangalore. He procures certain goods, use them for a period of 3 months, 6 months, 9 months, 12 months, and want to export the same goods because the technology has been upgraded and now he want to buy a new item, or he want the goods are not of a certain quality, so he want to change them. Or there may be any other reasons, for example, technological leapfrogging, or maybe other reasons, for example, he do not like the goods, or fashion has changed, or he has the capacity to expand it to a next level and he want to sell this particular machine which may be of a lower economies of scales and may not be fulfilling the capacity that to which he want to scale up. So he want to export the particular item after having taken into use. It should not be the capital goods. It must be a product which is used in an exportable product. And even if it is used, he will be entitled to drawback. So under Section 74, there are two types of drawback. Drawback on the goods which are imported into India and re-exported out of India. There are terms, there are conditions, and there are what we say, there are specific conditions which are imposed by Department of Customs that we will discuss. But you are in a logic, we can say that you are entitled to claim refund of that, number one. Number two, you import certain goods which are likely to be used in a product which has to be exported out of India, and you use them, you don't find them of a certain level and you want to re-export them, allowed. You can export them, but drawback rates will be at the lower side. We will discuss what will be those drawbacks. Section 75 has three types of drawbacks, and out of which I would like to emphasize only the first part, which is the goods manufactured out of imported material, because subsequent tax reforms in India has largely neutralized the fourth part. So the goods which are for which you have procured certain component from another country, and then the goods are manufactured. In earlier case, goods were not manufactured. There was no value addition. You imported goods, you re-exported goods. You imported goods, you used them, you re-exported them. Drawback. So goods were not put into manufacturing. Now goods are manufactured. So essential qualification for Section 75 is that goods must be manufactured. So you import goods which you use in an item which will be exported out of India, for which you want to claim the refund of taxes which you have paid at the time of import. Welcome, you can. Second is, then you procure certain component from outside and certain components from India, and you want to take refund of that. Welcome, no problem. So these are the four cases. Two cases in case of goods when Section 74 apply, for which goods are imported, re-exported without putting into use, or with use, both scenarios. Second case, Section 75, two cases. Goods are imported, manufactured, re-exported out of India. Goods are partly imported, partly locally sourced, for which a drawback claim is required. Welcome, you will get it. Okay. So dear friends, these are the types of drawback. This is the rules which governs that. And when drawback is given and when drawback is not given, let us understand that drawback is given on raw material, not on the capital goods. It is given on raw material which will be used as a input in what? In the product which will be exported out of India. Components, intermediates, packing material, even packing material you are entitled to claim a drawback. Let me take an example. There is a meat exporter based in Niryat. He want to he source the animals all across the country, cut them into meat and export it. Packing material comes from Japan. Can he claim the duty drawback? Yes. Packing material has suffered the incidence of duties for which he is entitled to file a claim. Drawback is not given on capital goods, on fuel and consumables with certain exceptions. Otherwise, on capital goods, never ever drawback is given. So if you import a machine, use it for manufacturing of certain exportable products, and you say that you want to claim drawback, forget, you will never get. On fuel and consumables, in certain cases you get, in certain cases you not. That is case to case basis based on certain notifications which are issued by Department of Indirect Taxes. That we maybe as the course mature, we will be able to delve into those issues also. Let us first focus on understanding the broad spectrum of broad skeleton of the export and import procedure. Then there is a output GST, for which under GST there is a provision to refund that or not to pay that, for which a document has been neutralized, GST RFD 11. We will discuss that in our next session. So we will assume that you imported certain cargo under for the purpose of re-export. Goods are imported, never manufactured, and re-exported out of India. In that case, you will get a drawback. Drawback will be as good as 98% of what you pay. So let us assume there is a gentleman based in Bangalore. His name is Mr. A. Mr. A import certain cargo. Cargo is electronics goods or electrical goods or automobile component or some any other item from China. Goods come. Goods are cleared at a dry port in Bangalore. Goods landed in Chennai. From Chennai, goods reach Bangalore. And he filed bill of entry, he paid duty. And after 25 days, he get export order from Dubai for the same goods. And can he export them? Yes, Government of India said no problem. We want to establish this country as a base for manufacturing, base for trading, and base for services. So our preamble of a foreign trade policy say India as a global center of manufacturing, trading, and services. Trading. What is this trading? So gentleman based in Bangalore import certain cargo, pay duties. When he export, he become lovely son of Government of India, lovely daughter of Government of India. And dear friends, in that case, he is entitled to claim drawback. Whatever he pay, he will get 98% of that refunded as. So 98% of that will be refunded and he will get that drawback. This drawback must be done within 3 months. Now, how this 3 months has to be measured? Dear friends, when you import cargo, there are certain proof of import. First proof of import is number 1, bill of entry. Second is the day you pay duty out of charge order. So the day duty. So these two things become very important. And in this case, out of charge order is important. On bill of entry, when you pay duty, out of charge order is given. You can take your gate pass is generated. You can take your cargo to your factory warehouse. So this gentleman file bill of entry, clear the cargo, bring the guards to his out of charge order is there. Within 3 months, 90 days, shipping bill must be filed. Shipping bill number must be generated. And he export the goods out of India. So what are the proof in that case? Number 1, shipping bill must have a Leo seal. Number 2, bill of export. Number 3, EGM. These are the initial proof that the goods are exported out of India. And if you file shipping bill under claim of duty drawback, these 3 documents are there. Nobody can stop you to claim duty drawback. So essential criteria to claim duty drawback under section 74 is that goods must be exported out of India, but within 3 months. In other cases, if you are not able, for example, in the second case, you import goods, you use it for some period of time. For example, gentleman imported goods, he opened the goods, he do not find them of a suitable quality, and he want to re-export them to third country. Can he? Yes. And such goods which are opened will be deemed to be used, although they are not used, but deemed to be used. So where the goods are opened, even if they are not used for 1 day, they will be deemed to be used. In that case, he file a shipping bill, follow the same procedure, he will get 95%. If it is more than 3 months, in earlier case and this case also, for example, you import certain goods, you cannot re-export them within 3 months, then you automatically graduate to second level, 85%. So whether goods are used, whether goods are not used, if it is more than 3 months, you will get 85%. More than 6 months, less than 9 months, 75. More than 9 months, less than 12 months, 70. More than 12 months, less than 15 months, 65. And within 18 months, if you export them beyond 15 months, less than 18 months, you will get 60% duty drawback. Dear friends, this is all about Section 74. There are certain preconditions. Goods must be previously imported. Proof is bill of entry. Duty must be paid. There are two proof. In case duty is paid manually, TR6 challan. In case the duty is paid online, using online, GAR 7. GAR form GAR 7. That is the form which is mandated for payment of duty in India. Goods must be exported within 2 years, preferably within period of 18 months. And in case you cannot re-export them and there are valid reasons because of which you cannot export them, in that case, you can get 2 extensions. For example, there is a gentleman based in Bangalore who is likely to export the goods within 18 months, but suddenly there is a flood in Chennai port, as it had happened in year 2015. Because of high water, the goods cannot be exported. So force majeure in that case. So he approached the customs and asked for extension. Customs allow them 3 months period. If the commissioner of customs is satisfied, allow them a period of 3 months. And again, he cannot export due to some very valid reasons like strike, like civil disobedience, like flood, like tsunami, like other, recently there is a, what we call cyclone Gaja. So such a situation may come up and you will not be able to export on time. In that case, there can be a second extension also. Goods must be identified as goods imported, means packing list must match. So when you import packing list and export packing list must be dicto same or capable of being identified, means should be of the similar nature. Goods must be re-exported, means there must be shipping bill number, it must have a Leo seal, only then. Market price of such goods should not be less than the amount of drawback claim. Very important document. Dear friends, this gentleman imported a goods. Our goods is worth 1 lakh rupee. Duty is 60%. He pays 60% duty. So 60,000 as a duty is paid. And this is a goods where it is a fashion and fad goods. So the prices go very down. For example, you import a car. Car is worth 1 crore rupee, duty is 60 lakh that you pay. 1 crore 60 lakh ki car, 1 crore 60 lakh is the price of the car. And you use it for a period of 18 months and you want to export it. In that case, are you eligible? Yes. But the price of the car has fallen to as low as what we call as 50 lakhs, 40 lakhs, 30 lakhs, or maybe 25 lakhs. In that case, are you eligible to claim drawback? The rules say 60% is what you have paid. That translates into 60 lakhs. 60 lakhs costs 6 times 36 lakh. If it is below 36 lakh, market price, selling below 36 lakh, drawback you will get is 36 lakh. You are getting export price is less, you will not get a drawback. Drawback below 500 are not processed, and you must file shipping bill manually to claim a drawback under what we call Section 74. These are some of the proofs we have already discussed: packing list, bill of lading, shipping bill, TR6 challan, GAR 7. So these are the forms which you must bear in mind at the front. Section 75 is far more easy to understand and easy to operate. How may I tell you? Dear friends, this section defines the drawback rates for the manufactured goods, which are announced after budget every year by the Department of Customs, CBIC, Central Board for Indirect Taxes. So they announce usually after a budget, when the tax rate changes, they form a committee. Committee gives a report within the time period of 3 months. So April, May, June, sometime in the month of June, you will have a new schedule, which we can download it from Google. I'll show you in just 2 minutes time how to download it. And dear friends, you see the rates which are prescribed by Government of India for the duties suffered on the product, and this is usually done on an exercise called standard input output norm. So how much is usually sourced? They collected data pan India basis from various factories. They collect about the amount of duty suffered. Based on that, they calculate the all industry rates, and you are supposed to follow the same rates. They are basically worked out on the basis of broad average of consumption of inputs, duties suffered, quantity of wastage, and FOB price of the goods. And they may define sometime drawback caps for certain cargo, where there can be huge differences in terms of base price and what the price you can charge. Drawback this under section 75 drawback is not given when it is under advanced license. For example, DGFT issues two type of licenses under chapter 4, advance authorization and duty-free import authorization. So if you are availing either of them, you are not entitled to duty drawback. But there are cases when even with these two licenses you can avail duty drawback, but those are very special cases, require a lot of documentation and pre-planning at the time of filing. As a journal rule, may I preach and may I teach that with advance authorization and DFIA you cannot get a duty drawback. Goods which are manufactured in bond under section 65. But section 65 specify the bonding of EOU, Export Oriented Unit, EHTP, Electronic Hardware Technology Park, and then BTP, Biotechnology Park, STPI, Software Technology Park of India. So these are basically dedicated export enclave where whatever is manufactured is exported out of India. And if the goods are manufactured in free trade zone, I mean special economic zones, you are not eligible for Jorsebolo duty drawback. Let me share with you now how to download the all industry rates from using Google. Google, dear friends, is our true friend. Let us go on Google and type here CBIC, Central Board for Indirect Taxes. It's a new name given to CBEC, Central Board for Excise and Customs, post implementation of goods and service tax. And you see the beauty of this Google. Here we go on customs and here we go on drawback schedule. We click it here and we would like to download the drawback schedule, and here it is written drawback schedule. We click it here and you just see with a click of mouse we got the drawback rates for almost all the tariff lines for which the drawback rates are published by Department of Revenue. 1 minute just, the file is downloading, and with God blessings the file is with us. You just see here these are the drawback rates which are given. You see tariff items, description, unit, drawback rates and caps. And let us see that these are the drawback rates. Drawback rates may be defined chapter wise, heading wise, subheading wise, and in cases it can also be on the basis of tariff line. So here you see it is on the basis of sub-tariff line, and in some cases it is on the basis of headings. And let us go down and see how the drawback caps work. Let us also see that also, so that we can understand what exactly and how the whole mechanism works. So I just discussed with you that where the drawback, there is a possibility of what we call as of pricing too high or pricing too low. The government may declare the drawback cap. So here you see in case of EPDM, which is under HS code 400201, we can see that there is a drawback cap which has been mandated. Similarly, let us go to chapters which are far more relevant in terms of drawback. You see here per kilogram on yarn of combed wool not put for retail sales. Per kilogram there is a drawback rate of 4%, but there is a cap of 62 rupee and 60 pesos. So the drawback cap is also important. And with this, let us move forward how the whole mechanism for section 75 works with. In case you are not happy with your all India rates, within 30 days from the date of announcement of all industry rates, you can apply for brand rates, and you can, or there is a tariff line on which the no drawback rates has been fixed. Even then you can apply for your brand rates. And in addition to that, there can be a scenario where you can claim Jorsebolo special brand rate. So we must study all those rules and regulations to understand what is required to claim a drawback. So a copy of shipping bill. Now we file shipping bill online, then copy of certified invoices, copy of bill of lading. These are the mandatory requirement. Okay. And then what we call a GST RFD 11 copy. Then there are documents such as freight and insurance certificate which are taught to you by Professor Harish. Other document which may be industrial literature, meat receipt, copy of your all industry rates which has been prescribed by Department of Indirect Taxes, and then test report. Such kind of document may be required by the up to 1 lakh rupee of drawback. The claims are usually processed by appraising officer AO, who is the officer of the Indian Customs. Above that, the file may go up to Assistant Commissioner, and there are norms, there are circulars which specify as the amount of drawback keep on increasing, the number of officers involved may also keep on increasing. For example, there is a drawback claim of 1 crore rupee. Even a small mistake will result into huge loss to revenue. So that claim will be settled by appraising officer. Then it will go to Assistant Commissioner, from Assistant Commissioner to Deputy Commissioner to Joint Commissioner, and this way there is a hierarchy. There is a layered hierarchy of Indian Customs, where more number of officers may be involved when the amount of drawback become high. And dear friends, once the claim is settled, usually in India claims are processed within 30 to 45 days, in some cases 60 days, in some cases 90 days. But usually within 45 to 60 days, the claims are processed. In some cases, I've learned that the claims are processed within 25 days, 20 days. But there are cases when you are getting a drawback within the time period of time. So within 3 months, you are supposed to get your drawback claim. Usually drawback claims are processed, but it takes time for the money to get transferred to your bank account because of because of some lacks of funds in those accounts by customs or by revenue agency. So as a result, I've seen that sometimes your drawback claims may be stuck. You can file shipping bill online and under Section 75, and your claim will be automatically processed by Indian Customs based on the documentation, based on the complied documentation. So dear friends, in case you are not happy with your drawback claim, you can file a supplementary claims. Usually your drawback claims are processed within 3 months. In case if the customs fails to process them within the time period of 3 months, they will pay you interest at the rate of 7%. And if erroneously the drawback is more with you, you are supposed to refund it from the date of intimation. Should you fail to do so, you have to pay interest at the rate of 15%. Custom reserve the right under Section 142 of the Customs Act to recollect it or collect the revenue which has been erroneously paid to you as a drawback. Okay, so you can make your supplementary claim if you are not satisfied with your drawback claim within 30 days. There are certain restrictions, and these keep on changing because now trade is a very dynamic subject. If your claim is less than 5,000 and where the drawback rates are less than 2%, usually claims are not processed. And in case FOB value of your exportable goods is less than the CIF value of inputs which are used, it means more funds going out of India. You are spending more to import certain cargo and you are realizing less. FOB value is less, CIF value of the imported cargo is more. No, because lovely son must earn the revenue to the country, must earn the foreign exchange to the country. No drawback is admissible where amount of drawback is higher than the present market value, as in case of Section 74. And less than 500 rupee, if there is a drawback claim, it is not processed. If goods are going by land route to Burma, Tibet and Bhutan, they are not processed. So with this, we usually cover the whole issues which are related to this. Every time the rules are very dynamic, they keep on changing. It is recommended to make a reference to your freight forwarder or to your CHA, custom house agent, or custom broker to understand properly what are the specific conditions that you keep in mind, what are the various notifications that you should keep in mind to get a timely claim of duty drawback. Dear friends, so we have discussed a very important subject, duty drawback, as we have learned that duty drawback is of two types. And the first kind of duty drawback is which is given on the goods which are imported and re-exported out of India, which again is of two types. Let me summarize you once again so that you must keep this in mind and can subsequently Google out the information and should be able to get duty drawback for the export that you make for your business operations. So first is Section 74, where the goods are imported, taxes are paid. When goods are re-exported out of India, government gives you certain percentage back. What those percentage are, we have discussed. Dear friends, sometimes you import goods, you use them for some period of time and re-export. Time limits are important. We have discussed that within 18 months goods must be re-exported. Government gives you refund on used goods also, and we have discussed in detail the procedure related to that. Dear friends, second type of drawback, which is the most popular drawback and is easy to avail, is a Section 75 drawback, where the goods are manufactured. When goods are manufactured, the following condition may happen. Goods may be manufactured by locally procured material. Dear friends, when we procure material locally, we pay GST. and we claim the input credit of GST. But some of the components may come from abroad and on which we have to pay what we call as custom duty. So custom duty must be refunded because, as we discussed, it is not the part of GST. So for that, government gives us duty drawback. And dear friends, for other taxes, GST regime has been extremely helpful because it harmonized the 15 taxes, 8 central taxes, 7 state taxes into one regime, where the detailed procedure has been explained how you can neutralize the input taxes as well as output taxes. For output taxes, it is GST RFD 11, and for input taxes, it is GST RFD 1. And in my next session, I will discuss that how we can neutralize the incidence of goods and service tax in the export operations. Today, my focus was limited to the incidence or the impact that you suffer on procurement of certain goods from international market. When you pay custom duty, that custom duty must be refunded. And we have discussed in detail how we can neutralize that. I think that this session will help you to neutralize the impact of taxes and following the golden rule that only goods are exported and taxes are not exported, and will help us realize the dream of a export-oriented country, a export champion country, and fulfilling the dream of our Honorable Prime Minister of India, becoming what we call as a developed nation at the earliest possible, as envisioned by our Honorable Prime Minister. Thank you very much.